We're here with Brian Ford, a highly accomplished CFO, a veteran, I would call you, who's really seen it all, and in a space that's near and dear to my heart, life sciences, pharma, biotech. Really, really glad to have you here. I'm looking forward to the conversation, Brian.
Thank you, David.
Maybe just to kick off, your background and how you got to where you are. What are some of the highlights of Brian's career to date?
Well, it's not a very conventional story, I can assure you of that. At university, I actually studied history and English. And I was worried about being able to find a job back in the early 80s. There was a pretty significant recession. So the optics of a history major getting a good job was probably not that great. So I switched and I took economics as a core. And with that, I tried to find a job in banking, but they were only hiring people who have their chartered accountancy certificate. So I went off and I joined then Clarkson Gordon, which eventually became Ernst & Young. I didn't know I had to go back to school and get a degree in accounting, a diploma. But I enrolled and, working with Clarkson Gordon and during the day and going to school at night, I made it through the whole program. If I'd known how much work it would have been, I may not have done it. I thought I was going to hate accounting, and I actually liked it. And I moved through the firm for 20 years, and I probably had 7 different careers. When I left the firm and started my own consulting practice, I started to realize that everything I did then and subsequent in my consulting roles was training me to be a CFO. So it was a little bit of a long journey. It took me, some 25 years to find my first CFO role, and I've been doing it ever since. So that's probably 15 years now, CFO. I never think, of it as a routine job. The routine job is really for the staff, the bookkeepers, the accounts payable, the payroll. The CFO is dealing with a whole bunch of different things at an executive level. And, most corporations have a plan and they have challenges in achieving that plan. And the CFO is a valuable partner at that table. And that's the skill set you really need to develop to be successful at this.
When you meet organizations and they tend to have the bookkeeping controller, what do you tend to find? What are some of the commonalities that you find in those companies?
Well, the first thing you really need to do is take an inventory of the competencies of the organization. Usually an organization that doesn't have a CFO doesn't have an effective financial plan for the organization. They don't see beyond the sales that are being recorded or the collection of accounts receivable. It can be very mechanical. And the expectation as a CFO when you walk into a shop is that they have a framework of internal control so that you can actually rely mostly on the processes and the financial information that you're given. Quite often, there's a gap between what those teams do and the level of performance they should be having. For small corporations, it's not a very big risk, but as they start to grow, they really need a lot more focus and fine-tuning on ways to improve the business, to finance it, and to report it. Eventually, a lot of small companies dream of going public as an exit strategy. A CFO is a very valuable resource to navigate through that process. At the same time, the CFO is heavily dependent on the staff. The most flattering thing for me is when one of my staff gets offered a better job. And you've got to have that perspective, because people will trust you and your leadership if you bring them along for the ride and help them improve. And if you listen to them, you tend to not overreact to things. You focus on solutions, not problems.
Sounds like a helpful skill or quality to have. Or I want to hear from you when it comes to biotech or pharma. That's a really unique business. Life sciences in general is quite unique. What are some of those unique elements? Obviously, many of them are pre-revenue.
Well,
That's
like mining, and I had a background in mining at one point, and there's a long business cycle, and there's exploration, development, and then operations, and a pharma company isn't that much different. You've got long term, research and development, early stage research to develop things, and then you get into the formal development program, clinical trials, and all of that, and then you get to operations. Hopefully, when you've managed to pass your clinical trial requirements, then you can actually start to get into business. And that cycle is quite long. You could spend 5 to 8 years in development, or a couple of years in just basic proof of concept. And remember that these things start in a lab, usually a university lab, and they'll think that they're almost in production, but the truth is there's a lot of development work that has to go around learning how to scale production from the lab to a commercial product. And then there's all the regulations that you have to comply with, and a number of things. And almost everything that's complicated in accounting, in terms of valuation and forecasting and making estimates as to the likelihood of a scenario happening. These, in fact, cover the waterfront of all of the accounting issues covered by generally accepted accounting principles. It's always interesting, whenever you do anything in this business, you've really got to consider how to characterize the transaction or the business against the backdrop of generally accepted accounting principles. And, and it's not easy. For instance, if you're a business acquiring another business, and that happens quite frequently in biotech and pharma development, you have to define who is the acquirer, and are you acquiring a business, in fact? And that's a tough test in accounting because, accounting considers a business to be inputs, outputs, and, processes. But if you don't have an output that includes revenue, sometimes GAAP in the US and the governments will say, well, you're not in a business, so it's very hard to work through those practical issues and find a characterization that fits the GAAP narrative.
So when do these companies tend to need to worry about real GAAP, IFRS? So like when they get out of the lab and they're starting to turn it into a real business, when do they need that? So when does the accounting complexity really come into things? Is that when they raise money?
It really depends. Yeah, raising money is a good indication of a time to get involved with the CFO. And quite often a smaller company will engage a consulting CFO or a fractional CFO to help get them started and pointed in the right direction. The reporting requirements for a public company, are they have tight deadlines and all kinds of things. It takes a company a little while to develop the competence to be able to do those things and repeat them every quarter. But there can be a lot of other reasons why companies need the support of a CFO, and sometimes it's debt related. Sometimes it's mergers and acquisition. They might want to, a small company might want to buy some assets or, another business, that's competing with them. So there's a lot of valuation work and other concepts that companies really need to think about. It's not something that a controller can really do. It's just a level of competency in understanding valuation and accounting to make sure that what the business objectives of the company can be met in compliance and with appropriate accounting principles. It's really whenever the business is starting to do something that's outside their normal comfort zone. And quite often, some of these ideas can be quite harebrained, and your job is really to make a bad idea fail faster.
Well, in a space with such a high failure rate, I suppose it's better to identify the certain failures as quickly as possible.
Exactly.
What is the failure rate that you've experienced, uh, just broadly within healthcare?
Well, typically on average, and this features in valuation models. If you're an early stage company, finishing proof of concept and going into phase one trials, which are fairly simple. Each product is kind of given an average failure rate of about 75% at that stage. And so in terms of valuing, you discount the economics of the whole program by that risk of failure. Now, when you complete phase one successfully, that success rate jumps to 50% from 25%. So that's when you can start accounting for more of the economics of the business, is when your risk of failure starts to drop. There's probably another 25% in phase three, but until you actually resolve the acceptance by the FDA, for example, of a new drug, there's always some risk of failure. Sometimes by that time, you've finished the trial, you've had a successful trial, you still got 5 to 10% of risk of failure because the FDA may not like your trial. They may be concerned about the standards of production that you've done, because they come in and they inspect all this stuff. There's always major challenges throughout the development exercise, but it starts at about 75% probability of failure. You resolve it over time as you complete each step successfully.
So those steps are going to have different investor profiles. Walk us through a little bit of, if you think of preclinical, maybe that's seed stage, all the way to, I don't know if it's when you're going for FDA or Health Canada approval, is that a Series A or and it may not be an exact science here, but how are those sort of layer as you progress through those stages, the sources of capital?
From a public company perspective, and I think it's wrong for people to sort of think that going public is going to solve all their financing issues. Yes, it provides access to capital markets, but you're too far up the value chain for the real investors at that point. So usually the starting point is you've got a small group of scientists who have got a good idea for a new drug, and they should really be thinking of using private equity or venture capital funds to get the initial rounds in. And those are high risk. They're people that are comfortable with the high risk and the high failure rate, and they negotiate terms that are very advantageous to them if the company wins. If 1 out of 4 investments is going is successful, it's got to be a pretty good return to recover their overall portfolio investment. Once you start to get legs on the development program and you have more assurance that it's going to be moving forward into the later stages, then that's a good going public kind of inflection point. Although, my own advice would be to keep it as private as possible for as long as possible. Because when you do go to the market, you want to have a higher valuation. And, that way you can raise money at a much larger kind of share price and less dilutive for earlier shareholders. Not that dilution is a bad thing. It can be a very good thing at times, but companies that are still too far away from revenue will eventually struggle to raise funds. So I think it's better for them to have a lot of private money behind them initially, and each company will make their own decision as to when they go public for access to those other kinds of funds.
And between phase 3 and, call it, like, commercialization,
yeah.
I mean, that could be a Series A, I suppose, on the heel of to fund commercialization. You would say, to the extent you could stay in the private setting as long as you can before going public, is it reasonable to be commercial and then go public? or does it really just depend on
Well,
what
yes.
type of
I mean,
business?
it's just a question of valuation. And if you've now launched the product and you are, achieving revenues and that sort of thing, then the valuation tends to be a lot higher because you've managed to pass all the risks. Whereas if you're in phase two, the valuation is only going to be limited, and so you're diluting people, um, who came in first with a poor valuation. So, the idea is to try and go public at a point when your valuation is escalating, so that you become an exciting option for investors in the public. If you look at the biotech space today in the U.S., there are probably 500 or 600 companies in the space listed on NASDAQ. 250 of them have less than 1 year of cash. Most of them less than 6 months. And it's very hard to raise money as a small company, long distance from revenues, and you're running out of cash. It's just your valuation starts to downward spiral, and those are the companies that tend to hire me to help them get out of it.
I was just thinking about that. That's a good segue to the messy situation. Walk us through uh, one of those experiences that you'd like to share, uh, where you walked into a real big mess, whether you got out of it or not. It'd be great to hear, what that looked like and how you went at it.
Well, sure. There was 3 or 4 years ago. Actually, it's probably six now. I'm getting old and I'm forgetting how old I am. But I had wrapped up a company that I got my start, and there's always been challenges in the companies that I've worked with. And as a result of getting out of one deal, the bankers who were financing us asked me to go in and fix another situation they had. And this is one where they had invested a lot of money in a private company, and the owners of the business weren't that confident, and they stopped phoning, the investors, tell them what was going on. So they hired me to go in and tell them what was going on. Should they shut the place down or invest more? So after a couple of months, I told them I thought it was a very good business, but very sick. They hadn't produced any financial statements in 4 years. They hadn't really done anything. They'd lost a lot of their business through loss of doctors and things to other competitors, and they were, very underutilized. So the banker, was very compelled by the story, and put additional money in, and we turned this business around. And 3 years later, all of the financials were up to date. We took the company public. We were able to get audits done on these things. So it was a real turnaround. And today, that company is still doing well, and they continue to grow.
Fantastic. So I guess the one of these segments that we've been doing on the podcast is the anatomy of a deal, and I'd love to hear from you, whether it's a capital raise or M&A transaction. You've done many of both, uh, but walk us through sort of soup to nuts what that transaction looks like.
Well, I said earlier that one of the things that you see that's missing in a lot of corporations when you join them is the lack of a decent plan. And one of the first things I put together for a company is what I call a 5-year plan, but I also have a 10-year plan. Even though the years 6 to 10 are a little unreliable and iffy, it provides, nevertheless, some pretty useful information. So the key thing is to look at the next 5 years and understand where your business is going, where your executive team wants it to go. And that 5-year plan enables you to identify and highlight the times at which you need new capital coming into the business. So think of it as an operating plan with sales and forecasts and cost of sales. and you can imitate a balance sheet and draw up assumptions, but you can't hide the hole that cash deficiencies present. And so roughly, if you do a good 5-year plan today, you'll have a runway usually of at least 6 to 12 months, 24 months, where you may have sufficient cash to operate. But what you really want to do is identify when you need to raise the cash, in anticipation of cash deficiencies. I would say you probably need about 6 months to close a deal, and I always try to make that 6 month deadline, or when I determine when I need the cash, is usually 6 months in advance of when I actually need it. My own personal policy is to never have less than 6 months of cash in the bank. And so that drives a lot of my behavior in going out to find a deal. One of the first things you need when you're doing this kind of thing is a very good securities lawyer. And I've been blessed. I've always worked with some of the best, Blake's, Norton Rose, Osler, and on the other side of deals, I've seen, all the old Heenan Blakey, all kinds of firms. So we like to make sure that you've got sort of a financing team in place, and usually the CFO, the CEO, and maybe a vice president of development, business development, will have been going out to do what we call non-deal roadshows, and you're trying to get a banker interested in you to represent you, to underwrite the deal. And then you go out to all the funds, the fund investors. You go to the buy side. You try to present some ideas, not with a specific deal in mind, but just to introduce you and warm them up to the company and its ideas. When we do the deal roadshow, that means we've actually put together all the information the investors are going to do. And that's often a package. We get the investors to, I wouldn't say commit at that point, but at least we have enough of a momentum going that the underwriter, they will start to put together an overall term sheet, which sort of covers the range of funds we want to raise. And they will also consider the market conditions to determine whether or not warrant coverage is required, and other specific deal terms. So you try to get this package together, and then you give it to the underwriters, sellers and things, and they go and collect the money from the institutional investors. And the trick is they call that filling the shoe, and the shoe is really the size of the placement. Hopefully you have done enough work, good work in the pre-deal show or the non-deal roadshow that keeps them interested, and then you're able to sort of close the deal within a couple of weeks of the offering being public. And you always try to make sure you have enough to last at least 12 months. I try to go for 24 because you don't want to keep going back to the well every year. And I think you'd find a lot of regulators would probably, terminate a deal if they wouldn't approve your prospectus if they thought you were going to run out of money within a year. Your planning, your 5-year model has to be flexible and adaptable to include all these changing circumstances and opportunities. But it can be pretty exciting when, an opportunity can fall in your lap and a chance to buy something that'll really provide the synergy between two organizations and supernormal growth.
How does that process look different to what you just outlined, which was more along the lines of raising money? But when you do identify an M&A opportunity, are you going out to do some of the similar things in terms of representation, getting the securities lawyer, building the team, and project managing your way to a transaction?
It's the same but different. You decide you want to monetize an asset. to finance one of the areas of development. So, or an opportunity comes up, somebody sent you a letter saying, are you guys maybe interested in this? So the first thing you really do is hire a banker again. So typically, you're dealing with M&A professionals who work for the larger institutional banks. And these are usually the, investment dealers. So what these bankers do is they actually kind of provide the handshake with the counterpart, and they introduce all the parties. They control a lot of the information that goes back and forth, and they coach the board into where they're going. And eventually, that deal comes out with a term sheet. And once you get to a term sheet, then most of the parties are happy with the price, the payment method, a number of things. Then the complicated part starts. A lot of deals will fail post term sheet acceptance because of the security agreements that are put into place, or what they call the definitive agreement. And those can be very, very difficult because you're really down into the nuts and bolts of how it's actually going to be executed. And quite often that's where parties and counterparties fall apart or fall away from the table. So it takes a lot of work to keep a deal alive from the time you sign the term sheet or the letter of interest to the time you actually sign off on the deal. And then with an M&A deal, depending on the size of it, you may have to call a special meeting of your shareholders to get shareholder approval. And in the U.S., that means you need to have a quorum at your meeting of more than 33%. And you have to have more than 50% of that quorum voting in favor of the deal. Managing that, for a widely held corporation, can be very difficult. So there's a whole bunch of things, but obviously, everybody feels good about a deal when they sign the term sheet, but the work is only just starting by the time you get there.
I know there are a lot of stories behind this that you can probably pull.
Oh yeah, yeah. But,
drawn in.
I can remember trying to close an equity raise when one of the shareholders decided to, and this was part of a hostile takeover bid. They felt they had been treated unfairly. They got an injunction against us to not close the deal, and the underwriter had the deal full. It was like a $30 million deal, and we had the bring down call. And the funny thing is so the deal was approved and it got stalled at the last second. But I had just gone into the hospital for bypass surgery, so so the next day I wake up. It's like 7:00 in the morning. My cell phone's beside me, and I was still kind of in pain from the surgery. And the lawyer calls me and says, well, we have to redo the bring down call because, this injunction stopped us, and now we've got it all sorted out. And that was a deal where that shoe was held for maybe 30 or 40 days while we negotiated with the hostile takeover bid parties. And I can't believe we closed that deal without losing any of the investors.
You talked about the challenges you had on a personal level there. You obviously have a passion for what you do, having your phone next to your bed, being in pain post-surgery. I guess, how do you balance it all? Do you find you're starting to get better at the balance? Being a CFO is a hard job, but how do you find work-life balance in your career to date and more?
The job can be 24/7 if you allow it to be. And I certainly am prepared to work 24/7 when we're under the gun for a special program or when we're trying to resolve a particular problem. I always make sure I get vacation time. And I also make sure that there are times during the year that we're not so intensely busy. And that does allow me the time to live life well and enjoy the hobbies and things like that. Finding work-life balance is a personal responsibility. Business can take over your life if you let it. And so you tend to sort of develop philosophies like, well, I work to live. I don't live to work. Uh, I do go on wine tours in France, almost every year. And I do have an observatory where I keep my telescopes, and at night, uh, but I'm not usually working. And if it's good weather, I can be looking at the stars and filming them and that sort of thing. So, you know, and my wife and I like to do a lot of traveling around and antiquing on Sundays and stuff like that. So you have to find time for those things, otherwise it's not worth it.
Glad to hear you're enjoying. As far as fractional versus full time, you've been doing the fractional thing, the consulting thing. You said you did right after you left the firm. Just talk to me about what you're up to now and how you compare those two, in terms of enjoyment and the variety of fractional versus being dedicated to one company.
I'm open-minded to both,
Yeah,
worlds. For a full-time job, um, I have to see, if it's really a good fit, if it's something I can really do. And usually the jobs I'm most interested in are ones that, are difficult, or the company is in difficulty. Um, I tend to sort of look at the jobs that nobody else wants. And it's the only way I can get a job because nobody else wants it. That's not completely true, but nevertheless, I like the fractional work. They're filling a specific hole in a business to address something in their plan that they can't do immediately, but they don't need a full-time CFO. So, an example of one of the ones I'm working on now, this is a question of helping them prepare a business plan to raise financing to acquire more business and expand. Um, this is the kind of situation where the company doesn't have much infrastructure now, and eventually they may decide they want a full-time CFO, and their business may get that complicated. We can talk about that then. But for today, I'm just helping them put together a plan.
I've called you about some pretty hairy situations, and you're always willing to take those calls and keen to explore. So definitely, you're not afraid. I'll tell you
No,
that.
well, I like business. I think I find it interesting. And I find
Yeah,
it interesting when businesses are trying to accomplish something and there's something in their way. And if I can
yeah,
help them clear that way, either by resolving issues or just adding the competence to their documents and reports, then I'm happy to do it.
awesome. I know we're at time here, but really enjoyed this conversation. You got just a wealth of experience, and I'm sure we could do a follow-up podcast here and continue with some of those stories. But really appreciate your time, and thanks a lot for the chat.